companies that had the highest quality patents. And then they started an index, like we're talking about sustainability index for Thailand. This is a patent index for global companies. And over this time period, this patent index was up 7%, and the Standard & Poor's index was down 4%. This is a pretty significant number. Why did this fund stop? Any guesses? Why would a fund that outperformed stop after 5 years? I know you know the answer. No demand. So there's a phrase in financial services. Financial services are sold, not bought. They are pushed, not pulled. Busy people don't spend enough time looking for unique offerings like this, so they buy what they're sold, generally. Sophisticated investors can find this, but again, that's the question. Why didn't institutional investors buy this strategy? Because there's not respect for invisible assets off the balance sheet. Logically, it makes no sense. Financially, it doesn't make any sense. Human nature, I guess it makes sense. So this is something that was real and then had to stop because there was not adequate demand. And some of those patents came from these markets. So in food, organic food. So here in Thailand, they're starting to become a thriving organic food community. Here's a product from the organic food community, from the food lab, 100% chrysanthemum, keeping me healthy. And others, there's renewable electricity, alternative fuels. So I think your petrochemical company is doing some of the renewable fuels and renewable alternative fuels and renewable energy. There's proactive wellness and healthcare, green building products that SCG is helping to advance, organic apparel, hybrid automotives. These are all double-digit revenue growth markets. That sounds great, right? Double-digit revenue? Who wants double-digit revenue? Everybody should raise their hand. Who wants slow growth? Double-digit revenue growth markets should attract attention. The challenge is, to some people, when you say, do you want to invest in organic food? They're like, oh, no. Renewable fuels? No. But they're growing double digits. So there's this thing going on in your brain of, I think because it's social or environmental, it must not be as good as traditional. Logically, doesn't make sense. Financially, doesn't make sense. It's human nature. So there's a challenge here, and I will show you lots of examples, that when you start to analyze a company from these factors, customer satisfaction, this is business 101. But when you read a financial report, I challenge you to find the customer satisfaction numbers in the financial report, in the annual report, in the earnings statements. You rarely see a headline of customer satisfaction skyrockets. So in order for you to grow revenue, there's only a couple of ways to grow revenue. Who knows what they are? What are the ways to grow revenue? Anybody? This is the interactive part. Revenue is driven by what two factors? Price and units. So you can increase your price, or you can create new stuff. Now, when you have a market, there's usually competition. So if you want a market with no competition, what do? You invent new products. And inventing new products and sustainability, these products exist because customers want them, and they're happy with them. And when you analyze customer satisfaction metrics, if you are unhappy, you will tell no less than 7 people. So customer dissatisfaction can destroy a business very quickly. When you are happy, how many people do you tell? And I'm quoting actual statistical numbers. If you're unhappy, you tell 7 people. You're happy, how many people do you tell? More than 1, like 2.5. So you have to work very hard to make customers do the marketing for you in order to build your business. And when you do, that's when the phone rings. Your mobile phone rings, of course. Now, another factor is employee retention. To get customers to be so satisfied, you need to train your employees to make them hyper excited about serving customers and working for the company, to put in that extra effort. And if you don't, you're not going to have a stable company. You're going to have a species that goes extinct. A third one, carbon efficiency. So energy is lighting this room. To light this room might be solar powered, might be wind powered. Hopefully it's not coal powered. So the more energy efficient and the less carbon intensive, these are all high coefficient factors. These are all secrets of the HIP index. Board diversity. What is the proportion of men and women on the board? What is the proportion of ethnicities and citizenship on the board? If we want the strongest answers, we want the maximum diversity. If we only have men, or we only have one ethnicity, or we only have Thai nationality, it will limit our thinking. And other organizations who do will have more resilient thinking. And then finally, legal exposure. If you're getting sued as a company, you're not treating somebody else that well. You might be stealing their intellectual property. You might be not treating employees very well. You might be polluting the river. Okay, so these are 5 factors in the HIP index that we look at for 7,000 investments, that when these are high, the performance of the portfolio tends to be high, and the risk tends to be lower. And why that is, to share some of my McKinsey experiences, shareholder return is profits times the valuation multiple. Profits are driven by revenue less cost. Revenue comes from new products and innovations. Profits come from employee productivity and cost savings. And then if you can manage your cost of capital lower, you can make more money financially. So this is from MIT, and I think the slides will be available. So some professors at Harvard took these types of factors. So this isn't the exact HIP methodology, but it's very close. So they actually did this after we did this. So hopefully that means it's intelligent. And so the professors at Harvard looked at companies that had more sustainability and companies that had less sustainability. And what they found was the companies with more sustainability over the period 1992 to 2010, so covered several business cycles, including the financial crisis, was that high sustainability companies' shareholder value outperformed low sustainability companies by 15 to 30% more financial return. And it's from Harvard, so it has to be true. So here's something, I'm not sure if this exists in Thailand. Is there a list of best companies to work for in Thailand? Who recognizes the best places to work? Enterprise Asia? No? Okay, so I'm going to show you what happens with this, and actually there's a global, a next analysis of it. So this has come out every year since 1998. It's a bottom-up survey. There's a nonprofit called Great Places to Work. It's around the world, including in Dubai, here in Asia. Great Places to Work sends surveys to all the employees across multiple companies, and the employees write back about what they like. And then they collect data from the companies about pay and diversity and other employee factors. And then Great Places to Work totals that up. And then they publish this every January. And as you can see, these 100 Great Places to Work, 10 of these, this last time, are nonprofits. 8 of the 10 nonprofits are healthcare. So in the US, hospitals can be nonprofit. 1 out of the 10 is called Teach for America. So students from university compete to teach in low-income schools to help change the trajectory. So that's one of the top 100 places to work. All right, so that's 10 nonprofits. Gundao, do you have a question?
No, just want to share that we just launched like Teach for Thailand.
Oh, great.
This year, so
Great.
it could be the next the best place to work for Thai companies.
I hope so. You should apply. Great, thank you. So of the remaining 90, 45 are private companies, family held or private, and 45 are public. So I'll talk about the results of that in a second. And you can see that these companies are hiring. If you add up all the jobs of those top 100 companies, there's 100,000 new jobs. So treating employees right doesn't cost money. It can make you money. Treating employees right doesn't cost you money. It can make you money. All right, so I see we have some CEOs in the room. So here's the question. What is your company's most important asset? Human capital? Okay. Anybody else? All right, who votes for human capital? Who says people are the most important asset? Who has ever told a room full of people, you are our most important asset? Why are you laughing? Why do you laugh when people are the most important asset? Because the next time you hear somebody say that, ask this question. Where are people on the financial statements? Where are they? Any accounting experts? People are an expense on the income statement. People are viewed as a cost, not an asset. They're viewed as a liability, not an asset. So this is the problem. This is one of the major invisible assets that is a high proportion of large companies that is not on the financial statements. And unless you measure this number, then you are driving the car backward, looking in the rearview mirror. Or driving at night. Hopefully you have night vision goggles like the kitty. So there is a company that's doing this, and actually their subsidiary is in Thailand. So there's 2 examples. First, we'll talk about Infosys. So Infosys is a high-tech services company based in India globally. They went public in 1998, and this green line is their accounting book value. The red line here is the market cap value of Infosys. So here's the financial dip in 2001 and the financial dip in 2008. And this black line here is a unique line. Only about 6 to 10 companies do this worldwide. About a half a dozen in India and a couple of one-offs I'll talk about in a second. So almost no company has a calculated value for this human capital value. One of the sources of the methodology came out in a Harvard Business Review article titled, "Put People on the Balance Sheet as an Asset." That article was published in 1967, more than 40 years ago, 4 decades ago. How many companies are doing it? At most 10. Now, I'd invite consideration for this as a calculated number for the companies on the Thai Social Sustainability Index. And you would be a leader for requiring it. So this human capital value number essentially gets calculated as if we were all part of an operating lease. So in accounting, we know how to calculate a lease value. A lease doesn't mean that I own you. It means that I benefit from the cash flow of your work. So when you do that, when you estimate the benefit of the cash flow from your work, the amount invested in people and training, that, and you discount it back, this is the net present value of human capital. And as you can see, if you add up the green line and the black line, this is a much better fit, but it also gives you a hint that you would not have seen if you're only looking at the accounting value. Why did human capital value go up when the stock price was coming down? Why did it make this gigantic leap? What did Infosys do during the financial crisis as other companies were laying off their staff? They were retaining and they were hiring. They were hiring during the financial crisis. And what happened was, as you can see right here from the graph, it's so plain that when the financial crisis recovered, the market cap jumped up even higher. That productive capacity of trained employees that they stole from competitors, some of whom might even been sales and relationship managers. And you know that sales relationships move with the people. And the technology capability allowed them to extend their lead. So this type of calculation is being done in Thailand. It's a company called Interface. Interface is a global company that makes building products. They have a plant here in Thailand. They also have a plant in Europe and in Atlanta, Georgia, in the States. They have said it is difficult to make more investment in physical capital, so we need to make it in human capital. But to do that effectively, we need to know what that human capital is worth. So that's an example to evaluate. All right, so here's the answer to the question. The 100 best companies to work for, if you invested in 1998 to 2010, the stock market average was about 4% per year. If you bought that 1998 list at the beginning and held on to it, you would have made 6.5% per year. And if every year that best companies to work for index comes out, you bought the new ones, you kept the ones that stayed on, you sold the ones who fell off, 11% a year. So by following the best companies to work, you can outperform the market. Seems simple. Now, if it seems as simple, and it's in a public media, and there's sophisticated financial investors, this should be impossible. Because in economics and finance theory, given to Nobel Prize winners, the markets absorb all public information as soon as it's available, right? The markets are efficient. Who thinks markets are efficient? It's dangerous not to raise your hand in the SET building. Who thinks markets are inefficient? So if markets are inefficient, that is your opportunity as for an investor. Sustainability is a market inefficiency. Too many people think that sustainability is a cost, not a value. They think it costs you money instead of making you money. They think about it as an expense, not a return on investment. Every investment should always be ROI. So this continues to exist. We got tired of waiting for a fund to start, so we created the Best Companies to Work Fund. Last year, 2013, we started it in February, and in mid-January, the best companies to work for were up 27%, and the market was up 24%. For something that has been public information since 1998, has an academic paper written by Dr. Alex Edmonds of the Wharton School, my alma mater, and now London Business School. This continues to be an arbitrageable opportunity. So should that exist here in Thailand, maybe it could be the same. Maybe not, but maybe it could. So this is sustainability. Sustainability is not just hugging a tree. Sustainability is not just volunteering. Sustainability is creating business value and reducing risk for becoming a 100-year brand or longer. All right, so here's another one of my favorites. This is the number of women on the board of directors. A tree-hugging company called Credit Suisse, global investment company, Credit Suisse, studied thousands of companies. We'll show you some of those numbers. From 2005 to 2011, so through the financial crisis. And this bottom line, this blue line, is companies with no women on the board of directors. Now, how many women are in this room? It's more than half even. Okay. How many people have a mother? If you were born, this should upset you. Your mother would be upset about this. Why? Because companies with no women on the board only made 12% return on equity. Public companies with one or more women on the board made 16%. You could make a third more money, 30%, 33% more money, by following this strategy. Sounds good, right? Maybe this could be another version of an index for SET. We can look at that too. Now, why does this happen? How is it that women as CEO or women on the board, what is it that generates higher return? And if you're mathematically inclined, the blue line has more risk, more volatility. So higher return, less risk from more women on the board of directors. Why is that? Women are more careful. Women are more sensible. You're gonna? Do you have a reply? So, everybody agree?
Women are more decisive.
Decisive? Okay. So men are less decisive in the boardroom. Yeah. Okay. Okay. Other thoughts?
I think women are more nurturing by nature, just the way they are.
Okay. Okay. So why does that matter in a publicly listed company? Why would that characteristic help a large industrial company? Shouldn't it be about strength?
Long term versus short term goal. Maybe women just more, by their nature, I guess, just look at more long term profits.
Okay. So why shouldn't we then focus on 100% women boards?
But then they start talking about bags and all business. So there's a kind of balance.
So there's a balance. So the world of human population is half men, half women. So why would it not be appropriate to have a half men, half women board? Financially, seems obvious. So this Credit Suisse story looked at this by geography. So this is North America, over 80% of companies analyzed, Europe, emerging markets, Latin America, developed Asia, emerging Asia. Now these are their categories, not mine, so when I show you the categories, don't yell at me. Now good news is 2011 numbers are higher than 2005, so that's good. But emerging Asia, developed Asia is 30% of companies, Europe, North America, 80%. So here we have Thailand. For this survey, there were 20 companies included. And so that's actually 80% of the 20 companies. So congratulations. New Zealand, 100% of the companies, there were only 5. Australia, 88% of the companies. This is actually strange because it's not a very welcoming environment for women in Australia. Malaysia, 42%, 43% here. China, publicly listed companies, 50%. India, 46%. Indonesia, 24%. South Korea, 4%. Now, South Korea, interestingly, has sustainability requirements. Japan has 11%. Yeah. So Japan and Korea, low number. China, high number. Thailand, very high number. Hong Kong and China, 50%. So Thailand has an advantage in this survey versus most countries. Now, the next step of this is let's sample more companies. But these are some of the largest companies. Now, what's happening in Malaysia is, starting in 2016, all public companies with more than 250 employees are required to have 30% women on the board. Required. 2016, Malaysia. Now, they did this in Norway. They set a requirement to have 30% women on the board. And the publicly listed companies said, we are going to delist. And the stock exchange said, okay. And nobody delisted. And now there is a high proportion of women on the board. The challenge was that it's now the similar women on multiple boards. So on the one hand, it did provide that gender balance. On the other hand, it hasn't expanded the universe yet. Now, what I can tell you is, in the studies where there are companies with women on the boards, that ends up creating a positive ripple effect to have more women in senior management and then more women in middle management. And actually, for a fair number of large companies, there's a good number of women in middle management. The challenge is how to get women from middle management to upper management and how to bring in at the board level. There's even some companies that whose customers are primarily women with no women on the board. It's amazing, right? Their mothers would be ashamed. Okay, so this is good news for Thailand, and hopefully there can be not only the disclosure of this into an index, but maybe even a more focused index for women leadership. So all of these factors, these customer satisfaction factors, employee energy and carbon efficiency, board diversity, legal exposures, and another 20 plus more. In looking at all these different strategies, it is possible to get higher returns. It's not guaranteed, it's possible, of a 5 to 33% premium. And what we can say with more confidence is sustainability almost always drives risk lower. You may not always get a high premium, but you will almost always get lower risk. And so if you get the same return for lower risk, that is a win. Certainly in finance and in accounting and in your portfolio. The same return for lower risk is a win. Any additional return for the same or lower risk is called alpha. So sustainability is an alpha generating strategy. And the HIP ratings, we cover $69 trillion worth of market value. Covers about 80% of global equity. We also look at investment grade corporate bonds. And in the US, governments and nonprofits issue debt. So we rate city, county, hospital, airports, as well as sovereign debt, which isn't listed here. So this is a picture of sustainability. Does anybody know who this is? George Clooney. Somebody I presented this once said, how would you not know those eyes? Okay, but sustainability tells you this. Is George Clooney getting fat? Unless you look at the whole picture, this is just looking at the financial statements. This is looking at sustainability. It shows you knowable but high. So looking at more data, off-balance sheet assets, invisible liabilities, and other factors that some people say are soft. People metrics are soft. They're not when people leave. When people leave, it costs you money to recruit more people, train more people. All right, so HIP The HIP index, which is one of the themes for today, it's a methodology. There are multiple methodologies of sustainability. This is a methodology that appears to be the only one deeply integrated with financial returns, financial statements, understanding the connection to financial statements. And it's based on Maslow's hierarchy of needs. So just like nature, we all need these things. We need to eat and drink. We need housing and clothing. We need